Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update, actually pre-market for Thursday, October 20th, 2022. In this, I want to do an update on the equity markets. I got the post out to you yesterday, and I did have quite a few things going on at home with a couple contractors yesterday. So my trading's been very light. As I mentioned, this is we are in the peak of earnings week. It really, I'm sorry, earnings season. Next week will really be the hump week, if you will, when all the remaining big fangs report. We have Tesla out of the way now, but I want to go. I want to do a video and just show you, some of the things I'm watching. It's a bizarre world out there. Like I said, things are. We're seeing the cracks. We haven't had anything huge break yet, but I still maintain, feel a high degree of confidence that if we continue the rate of ascent in both Treasury bonds and the U.S. dollar, something's going to break. In fact, I suspect things have already broken. You just don't hear about it. A lot of things can break, hedge funds, pension funds, and you don't hear about it right away. But again, the best case scenario is, we see an abatement in yields, which are unsustainable, rising interest rates, some kind of Fed pivot, or other central banks making some pretty drastic measures to stem up the markets, because everything is intertwined. And like I said, I'm not the only one. I've been talking about this for weeks, and I'm seeing more and more rumbling about it. Something's going to break here. This is just unsustainable. So let me go over the charts, what to watch, how to trade it, how to profit, how to stand aside if you don't know what to do. But yeah, I do this. My job here is to provide analysis and trade ideas, and then your job is to decide which trade ideas, if any, to take. If that analysis meshes with your own. Maybe I see something you don't. Maybe you see something I don't. I've been doing my best. I haven't been really 100% back at it lately, but trying to do my best to read the comments section, and I did yesterday, from yesterday's post, look through those. So I'm going to start out here with the currencies. I just wanted to show you, we just had, if you're listening to the video and you didn't catch the news this morning, the Prime Minister of England just resigned. She had been in power, or elected. She's been in office for I think it was 7 weeks. And if you follow the headlines, they've been flip-flopping there on tax cuts and then take it away. The crisis with the UK gilts, their version of our Treasury bonds, and how that affects the pension plans over there. Like I said, that'll be a shoe to drop here. I have very little doubt you'll be hearing more and more about that in the coming months to even years. And we'll see. We're in a bailout nation. We'll talk about bailouts, but sooner or later, this stuff, all these bailouts, and forgiveness of student debt and all this other stuff, it gets paid for one way or the other. It gets paid for in taxes, and that's probably one reason you're seeing just a relentless drop in Treasury yields. What country, in addition to the Fed, obviously quantitative tightening is certainly doing that, but who our debt is going to be if we continue to balloon our deficits, and just have reckless spending. It's going to really impact things, and we're going to have, going forward, in my opinion, oppressive tax hikes to pay for all this stuff that will stifle economic growth. So my outlook hasn't changed. I think we're looking at a multi-year, much longer recession than most can even fathom. When I listen to folks on TV and the experts come out, we're looking at something more akin to the 70s, late 60s, 68 to 74 bear market, something like that goes for years, not measured in months. The last several bear markets, you would say, even going back to the dot-com bubble, they were over a year long, but not much more than that, and so pretty much measured in months, 18 months, 20 months, whatever it was. All right. So there, I just want to show you the pound is just virtually no reaction. Little bit of a dip here. No, here it is. It's actually climbing on that news of the Prime Minister's resignation. But let's start out. I'm on currencies. I'll get back to that in a second. Let me start out with the equity markets. That's so if you get this, you're watching this video, you might even get it before the market opens today. Just show you what I've been doing when I'm trading. As I've mentioned recently, you tend to oscillate or more accurately, I should use the word vacillate. Oscillation is a steady motion. You think of a fan, oscillating fan, it turns regularly back on, from one side to another, those floor fans that oscillate. Vacillate means moving back in a more regular fashion. So the markets have been vacillating around that key level that I've been talking about now for, goodness, a while. The previous lows from mid-June, it's almost uncanny how well this level is acting as support and resistance. We rallied up, put the bullish engulfing candle, tried to pop it the next day, but got rejected. That was the rejection. Big red close after taking out intraday. The following day, that was Monday of this week, we parked exactly on it. I mean, right on there, that little green candle closed. Then we popped above it, and we went down, and we kissed it, tested it from above, and that was a successful back test. That was Tuesday. Look at that, right on that line. I've not modified it. That is the actual low there. Yesterday, we had a down day, but that acted as support. We took it out intraday briefly, I mean ever so slightly. You have to really zoom in on these candles to park right above it, and look where we're trading now, right on it. So say what you want about technical analysis, but it'd be impossible to argue that this level is not technically significant. And like I said yesterday in that post I got out to you in the morning, at the risk of oversimplifying it, and I can't emphasize that enough, that's pretty much my takeaway. It is oversimplifying to say bullish when you're above, bearish below. And of course, I always say you're trading on a daily time frame like this. All that matters is how you close the day. And so we're not talking, a close at 269.26 being bearish. You're talking a solid candle. When we start, if and when we are going to walk away from this level sooner than later, that I can tell you. And so what you want to look for, a big red candle down on the rejection, or a big green candle up. Now you have that previous reaction high that really would need to be taken out to spark some more buying. There's plenty of resistance on the way up, and those are levels you can trade off of. And again, my guess, I have seen the market sell off or rally hard before the big fangs report, and I'm talking Apple, Microsoft, Amazon, Alphabet, all yet to come next week. And so you're likely to see a little more chopping around until they're out of the way. And then, of course, you always have the markets will start eyeing the next Fed meeting. That'll be the next big thing. But, okay, so until then, what to do, how to trade it. Well, you're not going to swing. If you're a swing or trend trader, you've been frustrated lately because you're not going anywhere. You went, you were short. You had a big reversal that day. You were upset. The next day you were happy unless you flipped out. So at the end of the day, the markets are trading right now today in pre-market, that white candle, exactly where they were at the low back on the 29th, all the way back the end of September right here. That bottom of that candle, that's that same level. That's when we first tested that June low. And if you want to say, talk about investors and long-term trend traders, well, they're today, right now, trading exactly where the market was trading when it bottomed in mid-June. So that's it. So, okay, where am I going with this? Well, if you want to make money, you can't squeeze blood from a stone or water from a rock. One of those is, I think, the British saying, and the other's U.S. Blood from the stone, water from a rock. It's, in other words, it's hard to extract money as a trend trader or a typical swing trader when the market's going nowhere. But as an active trader, I've mentioned recently, and I'm doing more and more of this, just sharing what I do. This site was never about day trading and very active trading, although over the years I've always shared those setups. I used to at one point be active in the trading room. I just don't have the time in there anymore. Focusing on my trading full time, and a lot of this stuff is so fast in and out. I can't post an entry or an exit. By the time I get it out there, it's too late when you're trading the intraday charts. So I've been resorting back to what I call very active short-term swing trading, which is also a hybrid. Sometimes they're day trades. The typical definition is if you're in and out the same day, it's a day trade. But a lot of these trades last a day, 2 days, sometimes 3. And this is that. So where I wanted to go is that 10-minute chart I've been talking about. The technicals work exactly the same, but what you're doing here, you're zooming in. This is just the last few days here. Here's your day breaks down here, the 18th, 19th, 20th. So here we are today, and although you can't really trend or swing trade when the market is consolidating around a key support level, which it's doing right now, you can certainly make money actively trading. And most active, myself, I use futures. You can use ETFs, QQQ. You can use the leverage ones, SQQQ, TQQQ. Personally, again, I like the futures for various reasons, including but not limited to the fact they trade virtually around the clock. So I can go to sleep and sleep like a baby, knowing I have stop losses, because if there is a big shoe to drop, something that's really going to rattle the markets or explode them to the upside. The risks, like I've said recently, are bilateral. If the Fed comes out and does any type of even slight pivot, mention that they're going to pause or cut back quantitative tightening for now, or kind of indicates they're going to maybe not hike as much going forward or pause the rate hikes, the market could explode to the upside. Likewise, if a failure of some type of financial institution, a bank, a broker, hedge fund, or some problems with a big pension fund, anything, it could be anything, comes out, then the markets could crater to the downside. So that's what I mean by bilateral risks. And if you are trading ETFs, then you can't control that gap. It's going to happen, and you're going to have your stop loss triggered at the open if it goes against you. And so, futures, Friday night, yeah, you do know you're going to have to go home with them until Sunday. They pick up again Sunday evening. They start trading. So that's when you have the biggest risk trading futures, that period. And of course, you can manage that. Don't go heavy, long or short into a weekend. Other than that, put your stops, and there's plenty of liquidity in things like NQ and ES to trade that you can use stop loss orders instead of stop limit orders. Stop limits, they can get bypassed, so I'm not a big fan of stop limit orders. All right. So where to go? Well, here it is. You can just see, trend lines. Mainly look for these divergences. It's pretty simple stuff. Divergent high. And obviously, sometimes if you get a divergent high into resistance, that's an objective shorting up. Other than that, you can use, very short-term trend lines. You can see right there, you had a small minor uptrend line. There was a sell signal. There was a secondary trend line that was broken. And typically, these trends reverse once you've got the divergence in place, just like on the daily and even the weekly time frame. It was the weekly charts that got me very bearish and short, at the highs. And, when in the last bull market, we were shorting the NQs for long-term swing trades back in November of last year when the NQ and the Nasdaq 100 stopped, and QQQ as well. So just like those weekly charts can be very useful in helping predict trend changes, same thing here on the short-term time frame. And so again, we're looking just a 10-minute chart. 5-minute works well. You can use a 15. Typically, the shorter you go down in time frames, the shorter the trades are going to be. And if you can use, like I like to do, multiple time frames. And I'm always going to check and see what the 60-minute looks like, what the daily looks like, because let's just say you're looking to short a little breakdown here on the 10-minute chart, but you're not paying attention to the daily chart, and there's big support just below it. Well, that breakdown in that little 10-minute divergence is probably not going to play out for a good trade, because the buyers that are trading on the more significant daily time frame are going to step in. So those are things to look at, and that's it. You can see all divergent high, drop, divergent low, rally, divergent high right here. That was, they're not all marked, but at some point they were. Sometimes my lines just disappear. That was a little divergent high right there, drop into the divergent low, rally. And so here's what's happened since yesterday, or in the last couple of days. You had a nice clean right here, clean little bullish falling wedge pattern. Very good. This is the support I've been harping on. It's about 11. This one is 11.017 right here. You also have support on the more significant time frames, the daily, around all around this level. I called it, I think it was 11.100 when I look at the 60-minute chart. But you can see when you zoom down here, why is that support? Look at all these clean. That's a nice reaction. We broke it, back tested there. It was support, 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 support. And then when it broke, it didn't just kind of meander on through there. You had waterfall selling and a big drop. And then when you recovered it, that was very bullish. You were a little stretched when you took it out. That's why they back tested. When you get a little bit over, market gets ahead of itself, it usually will come in on a breakout and back test, and then boom. So So that's it. You had an opportunity to buy it here, especially when you had divergences. Then you had another opportunity on the breakout right there. Then you had, if you missed it, it came in one more test, another chance to go long. And then today, this morning, we rallied right into, this is the primary downtrend line. Let me change out my colors here and just, tell you what I spy with my eye, the way I see the charts. So here's a trend line. And so, this morning I had to close a close in reverse order that I went to bed with, to sell longs and go short. I saw it pop this morning. But I almost pulled out. I was going to, and I was going to wait and see because I knew we had all the economic reports, and then of course that and they were the pending announcement from the PM over there in the UK. That was also at 8:30, and so I wanted to wait and see. And then and it shows a discipline too. You never got, and that's one reason I was ready to, if we built on these gains, flip out of those shorts, because we never really closed above there on a closing basis. Remember, these little white parts are called wicks on the top of the candle. They're shadows, and the shadow on the bottom is called a tail, and if the shadow is up above, it's called a wick. That just means intra-period, but then you close each time. NQ closed right about on that trend line right there, and so it never had a breakout. And on top of that, it put in a little divergent high when it did so, and so that was bearish. That said, stay short, or if you didn't have a position, you would have shorted, especially the failure. And now we've taken out this trend line. That's going to open the door, I think, to more downside and probably take us down here. I mean, this is a first support level, but yeah, as of now, and that's short-term stuff. And you know what? Okay, call me crazy. I'm just doing the video, and I get distracted sometimes when I do these videos. So I just covered that short position right there. It's where I expect a decent chance for a reaction. We could go lower, but this was a pretty small divergent high. And remember, we're vacillating right now around this support level. So, and I think that's going to continue until I see a definitive break one way or another, to the upside above the recent highs or down low. Keep these trades small. If you're, I don't have to tell you this again. If you're a day trader or an active trader, that just the drop off this morning's high was about what is that? I'm trying to get up 1.2%. A single contract to NQ, and that it's going to put probably over a couple $1,000 or at least 1,000 in your pocket. I don't know. I trade multiple contracts, so that's a very well worth it thing for an active trader. And again, if you trade futures, I don't have to tell you. Even if you trade ETFs, you take the amount of leverage that you're comfortable with on those. And everyone has different portfolio sizes. So some people, they're happy if they get $100 on a pullback trade like that. And again, everyone's going to start small. Well, some people start larger in their trading account, and then some start smaller. All right, but that's it. I just wanted to kind of show you that, and the takeaway is it's going to be frustrating, I think. I'm always on the lookout for the unexpected or anything that may happen, meaning although I expect we can flounder around or will likely flounder around into next week, I'll react and maybe, position in my longer term accounts differently should this market break decisively one way or another before then. But again, to do that, it's going to have to at least take out that recent high, and I've talked about it. And we start going lower. If we fail this trend line breakout right here, that would be bearish event number one. Going back below there, taking out that low, and of course taking out that low. But again, take all these little breakouts that happen or moves up or above or below the 269-ish level. Take it with a grain of salt until the big fangs are out of the way next week. Because like I said, you're going to probably have a lot of traders waiting and seeing how Apple and Microsoft and Alphabet, what they report and what kind of guidance they give. All right, let's loop back to the currencies, and then I'll segue into gold. So USD/OLR, here's the dollar index, just waiting, just like Treasury bonds, waiting for that breakdown. It's been a very strong move in the dollar, to say the least. This is your uptrend line. This is a daily chart. You can see the dollar index, a lot of reactions there. It recently put in a divergent high. Divergences are not a sell signal. But usually after we had a divergent high right there, You can see at that point we had lower highs on the indicators, and you certainly got a correction. The trend resumed in a bullish trend. Negative divergences often only play out for relatively minor pullbacks. Just like in a bear market, the positive divergences end up, they're good for bear market rallies, but they're not taking the market to new highs. So, but sooner or later, when you go out to the bigger time frames, you're seeing again, this is a parabolic advance in the dollar. It is parabolic runs in just about any security are number one unsustainable. And the reason it's unsustainable, look, you can get a blow off top. It's not to say the dollar can't go up anymore, but the more it goes up, the more it's going to crash. From my experience, I've seen quite a few parabolic runs in many types of securities and things before, and they almost all end the same way, with a near crash that's just as powerful, if not more powerful, on the downside once that parabolic trend ends. And the parabolic, is when you have can't draw an uptrend line. You have a series of uptrend lines. It's a parabolic curve, is what it is, parabola, and that's how the dollar index looks. And again, it's unsustainable. Because it's not to say that the dollar can't keep going up. So maybe the rally in the dollar is sustainable for a while, but again, this is where things break, because this means the dollar index is soaring against other currencies are crashing or collapsing against the US dollar. And it affects everything from international trade to settlements to debt repayments, from other countries that hold debts denominated in U.S. dollars, et cetera, et cetera, et cetera. So it's just a very unhealthy thing. And so that's why when you zoom down to the daily chart, like we are here, you can see that was our first trend line. Then you have a steeper trend line and steeper. So it's a series of increasing trend lines which give you that parabolic advance. So take out the first one, and then boom, there's support level. First price target. But usually after once a parabolic advance ends, it tends to slice right through or have very little reaction or minor reaction on those levels, especially once it becomes clear to all that the trend has broken. So you may not be able to actively game that. In the takeaway here, and I've been talking about it for a while, when the dollar breaks down and starts moving lower, that will be bullish for dollar-sensitive assets. One of my favorite being gold. I give you the setup here, and all I'm doing is just extending the lines. The setup given out the other day was right on a break of this trend line. Well, the trend line hasn't broken. I said two things. You had to break down, the dollar had to break down, the euro break out, as well as gold breaking out. Well, gold never broke out, but the setup is still there. And if I liked it back here, I like it even better now as a setup because we have even bigger divergence. Typically, the bigger the divergence is, we're about comparable right now to this previous divergence. And let's see what the dollar did. What gold did at that point. Let me measure it up for you. That was a 7% rally. It was a bear market rally, but hey, I'll take 7% in a few days, all day long. So that's what we're looking at here. And then finally, if we take out, if you look at it this way, we have another low here. Traders love to buy tests of previous lows. That's what's going on, remember, in the stock market right now, testing the June lows. And then let me go out to the longer term chart. Let me use GLD for you. We'll go to the daily. GLD, this is gold ETF, and you still have, as I've been pointing out for a while, positive divergence. It started to play out there for a sharp rally, but it got sold into. Why? Because the dollar keeps going up. There was a little abatement, dollar pulled back, euro rallied, dollar pulled back, and that gave us a little rally, but it got sold into with the dollar going on to make new highs. And but however, these divergences are still intact. It's also just a back test of this trend line right now. But again, to be safe, if you zoom in, this is a daily chart, but if I go like this is that same downtrend line on the smaller 60-minute chart. So you've got this series of little downtrend lines forming these wedges, and now ultimately a big powerful buy signal for me is still going to be a recovery back above my buy zone. This 158 was key support. I was targeting that all the way back here, at least listing this buy zone. We had multiple pullbacks to that level where gold rallied, and it broke it. So right now, from a longer term perspective, that is bearish. Gold's in a bearish technical posture. It's below major long-term support. But I suspect, because again, the rally in the dollar is unsustainable, and if and when that breaks, gold can recover. And if it recovers, then you have all the makings. This would be a bear trap, i.e., a false breakdown, and then boom. At that point, you want to hold on to gold and just set your stop below the recent lows, or trail it up, and it would be a, we'll take the charts as they come day by day. We'll continue to monitor the dollar or the euro. I like to watch euro USD. Same thing there. Needs to take out that trend line. This is a daily chart. But on the 60-minute chart, the euro has been working its way up. I covered this recently. We put in a divergent low right here on the 60-minute time frame at the end of September. We rallied, broke out, nice clean breakout. Then we came back down. We put in, excuse me, another divergent low, which has has the potential. Right now, it's not yet there. I wouldn't call it yet, but the potential to give us all the makings of a new uptrend, because an uptrend is security making higher lows, which we have so far, but you need to make higher highs. So we need to go on and take out this previous high. And when you do that, you're also going to have, you can draw a downtrend line. The same one I showed you on the daily. This is a symmetrical triangle pattern. If you pop the top of that symmetrical triangle pattern, that alone is probably going to just punch you right above that previous high right there. And again, this is what you want to see. So if you get this, I can all but assure you gold is going to break out of that 60-minute bullish falling wedge. And if not, I'll tell you, this market's been, one thing about it, you got to give it credit. The trends are strong. Remember, natural gas was going up, up, up. It just wouldn't stop. Then we shorted the highs recently and we rode most of that down. I'll get to that in a second. I threw it out as a new trade idea today. But like natural gas, I always say, is a trendy little sucker. That thing's either full throttle up or full throttle down. There are periods where it consolidates, but for the most part, it's been going up or down most of the time in a pretty strong trend. And then treasuries are the same. We're still waiting. The most important thing, in my opinion, let me move this histogram away, go to the daily chart, is we need to see this uptrend line. TYX is a yield on the 30-year Treasury bond. So Treasuries continue to make new highs. I know last week mortgage rates were flirting with 7%. In just 1 year, about a year, they went from 2.5. I think the average was 3.5. I had refied at 2.49, which is still, I can't believe it. Free money, locked in, tax deductible. I mean, why pay that mortgage off? Anywho, and now we're talking 7%. So what hasn't been fully reflected yet is the impact. You're seeing the things. The refi has come to almost a standstill. Who's refiing at 7%? That didn't do it last year at 3%. It just, so you think of the impact, and these things take time. So the banks, that have were driving a lot of profits from this huge refinancing boom that had gone on for years. That's drying up, and of course, you're going to see new home sales and existing home sales really hit the skids. And again, that data is lagged. There's a lot of indicators that are pretty severely lagged. The stock market is real time. Treasury bonds are real time. But again, look how well defined that uptrend line. So you break that one. Treasuries have also gone parabolic. You're going to go down to the next trend line, most likely. Maybe a little support there. But I think we'll drop all the way down here to 29.41. And again, that's the yield on the 30-year. TLT is the ETF, and there's its comparable trend line. So we just keep moving this. As of now, still clinging by the skin of its teeth, clinging to the divergences, but they're still there. No signs of a reversal. And again, this has just been a signature of this market, just these trends. But once they change, then you're likely to get like I said, a real strong rally. And on treasuries, that would be now about to that minimum target there, about 108. It would be about a 12.5% rally. You look at the picture. Oh, and one more thing I want to show you. TYX. I showed you the yields from the long-term charts They're at just last week. They were getting TYX was close. Now it is there. It is at my 41.65. That's a yield of 4.165 on the Treasury on the 30-year. Look at this. That was great support, support, support. It broke waterfall sell-off that validates that was an important level. We regained it and then back tested here, held above it. We did whip through there a few times, but you can see quite often it acted as support or resistance. Once you took it out, attempt to get above there, never did. Anyway, that's a pretty significant resistance. I'm sorry, yes, resistance level due to all those reactions. That seemed to be support leading up to the financial crisis. This is 2003, 2005, 2007. Finally, in the financial crisis, it broke that last bear market. And again, everything got wonky after that because the Fed came in and they were the biggest buyer and buyers pretty much at that point of Treasury bonds. Gross manipulation of the markets, intentional, and it's not like they hit it, but they destroyed that natural mechanism of price discovery for a while there. And these are all all these zigs and zags are due to bouts of quantitative easing. And of course, this is the nuclear option when they overdid things when COVID hit. And now this is them unwinding that trade and the markets unwinding the trade. And then most importantly, make no mistake about it, this is a long-term trend line has been broken. There was a primary downtrend line. So I believe interest rates have entered a new secular bull market, meaning they've got more to go up over time, but they've now run into a really significant resistance level on both TYX, which is again the 30-year yield. TNX is your 10-year bond. You want to look at them all because the more you have running into resistance. Let's see, I can put a line right here about where we are right now, and look what that comes over. There's resistance there, support, support, same support going back into the 90s. That was 98, 2001. And you can see it's a level. It's not the best resistance, but it's a pretty decent resistance. And again, you have these big divergences still in place on the weekly chart that say when we get a trend reversal, it's going to be powerful. So TNX, the 10-year yield, needs to break this. Remember, the bond prices are just inverse to the yield. And then it's going to come down here, probably hit that secondary trend line. But I think we'll get a back test. This is that long-term primary downtrend line from the early 80s. That's our secular bear market in interest rates. I think we're going to get another back test. We already broke it and back tested it once, but I think one more back test, and that would be a pretty big move on the 10-year. This is what it looks like on the weekly chart here. IEF is your 10-year Treasury bond ETF, and it's also clinging onto that divergence by the skin of its teeth right now, but it's still there. You still have much lower lows in price against equal lows in the indicators. That is positive divergence. And you have a very, very steep downtrend line, bullish falling wedge. So when this breaks loose, when we snap this, probably run right up there to that 99.65. I think you'll see a massive short covering rally, a lot of institutions buying into bonds, and on the 10-year bond, you'd probably see it snap up. That's about a 7% gain from where we're at today. Now, we haven't broken it. We could go lower. If you go much lower, you start taking out the divergence. I think, like I said, the risk reward to me is very favorable right now, despite what is a persistent downtrend. So it's not an all-in moment. All-in moment comes when you start to break out, and you can zoom down to a 60-minute chart like this if you want to hone in on your entries. You've got a nice downtrend line here. You had one little whipsaw there, but other than that, there's a nice 60-minute bullish long wedge on IEF. There's your targets. I think I already gave you before. TLT, same thing. There's your downtrend line right there. Extend these divergences, pop that, run up there, hit that, get a little reaction if you want to take profits, but I think you'll swing it all the way back up there at about 108. All right, so that's gold, bonds, dollar. That's about everything. All right, let me just stop it here, get the video out to you guys. Like I said, stock market's most likely going to be a grind fest for the next week, but be prepared for anything. If something comes up and we break one way or the other, it might be time to jump in, long or short. But these are the levels I laid out earlier in the week, and there it is. They're dancing. That's that 269 right there. Look how we're just dancing on it. pretty much all week. And you had an objective short right here when you gapped up to it, that 275.24. And we've been trading each of these levels is coming into play. This one's been resistance. You could tweak the lines at this point a little bit, but that's it. That's just the range right here. And bearish below there. There's still a gap to be backfilled, and nothing would surprise me at all to see a little shakeout move here. See if the market makers can pull it down, clear out all these stops. I can tell you there's a lot of stops right there, and so you might get a backfill. Maybe it'll be the real deal, but it wouldn't surprise me to see a little false breakdown and whip back up there. And then you still have this significant downtrend line that's going to come into play as resistance. Anything much above that, that would be a breakout. That would be bullish. So probably take until next week, my guess, to see that if it's going to break out. So that's what you want to watch for. Likewise, anything to the downside. Maybe the early makings of an uptrend line here. I'm going to wrap it up. We'll see. This is, like I said, chop, chop, chop right now. Trade the intraday charts if you're inclined and you have those skill sets. Otherwise, be patient. Let's see how things evolve into next week, and then hopefully this market's going to show us its hand, whether it wants to the next tradable trend for swing traders and trend traders, meaning double digits, whether that's going to be to the upside or the downside. And unfortunately, I can flip a coin right now. Like I said, the risks are bilateral, and the technicals too. My long-term trend indicators remain bearish, but yet we still have those positive divergences on the daily chart right here, daily time frame. So it could go either way. All right, guys, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.